Hello. So today we are to take the closer look on the global financial crisis and on the policies which contributed to the market failure, to the very occurrence of global financial crisis. Okay, so basically speaking, the period before the global financial crisis was generally the period of prosperity. And to a great extent, this was caused by increase in aggregate demand, which was stimulated by the following factors. So first of all, there were innovative financial instruments and services. By saying this, I mean both financial services for consumers, for households, and financial services and instruments for corporations. Sorry. For corporations. So this implies that generally speaking, demand for money increased. So consumers got more opportunities for raising funding, so the same happened to firms, and as a result, as I mentioned, aggregate demand increased significantly. So the additional factor was increasing concentration of the banking sector, and by saying increasing concentration of the banking sector, I mean that banking industry was dominated by several large banks. And actually I like this formulation a lot, too big to fail. So the idea is like this: when huge part of the entire banking sector is concentrated within several large banks, then their financial failure will be externalized automatically. So their financial failure will affect not only them, but also the entire economy. And this actually means too big to fail. So there was some implicit governmental promise that if something happens, government would provide financing in order to prevent bailout. I mean implicit because there was no formal agreement, that if you fail, we will give you money, do not worry. But at the same time, everyone understood that if those banks fail to handle their financials properly, then government will provide support. There was the growing role of the rating agencies, and if you're not familiar with this, a rating agency basically estimates the level of risk associated with particular investment. So there might be corporations, government bonds, whatever. But the problem is that they are not perfect. Like often they overestimate or underestimate the level of risk associated with the investment, and subsequently they do not provide proper judgment. So this was the idea. Rating agencies were over optimistic about many corporations because market value was increasing all the time, prices were increasing, and so on and so forth. So they rated those corporations as good and reliable investment. At the same time, due to their high level of debt, those corporations were definitely not a good and reliable investment. So they did not deserve that much trust as they were paid. So this was the additional thing. And finally, we have to underline principal agent problem and search for yield behavior. So, generally speaking, principal agent problem is associated with asymmetric information. You do not have to know all the underlying theory behind this. You just have to know that it's really hard for banks to control the behavior of their agents, like bank managers, CEOs, and so on and so forth. It also applies to corporations, by the way. So if it's impossible to figure out whether managers indeed do a great job and deserve their high salaries, or they do nothing, usually corporations and banks establish some incentive schemes. Like we do not pay you salary because, of the fact you're employed. Instead, your salary depends on your achievements, like let's say indicators and so on. And in this case, those indicators were based purely on profitability. So the level of risk was not taken into account, and this motivated agents to undertake profitable decisions, even though those decisions were extremely risky. Because, owners, like shareholders, were able to observe only profitability indicators, while assessing true level of risk was kind of a complicated task. So as a result, this system of incentives facilitated search for yield behavior, like seeking for the higher profitability and neglecting potential risk, which again was one of the reasons for the relatively recent financial recession. Okay, so when it comes to risk, we distinguish between three basic types of risk, although it really depends. Like you can see the variety of possible systems of risk classification. Like nevertheless, in this case, we have liquidity risk, risk associated with insufficient liquidity. For instance, you can think about banks. Like that when you put your money on deposit, bank does not, store this money in the bank. So bank uses your money in order to issue loans, credits, and receive profit, which is fine. But imagine what will happen if all the consumers who have their money on deposit in the bank would like to withdraw it at the very same time. So bank will face liquidity crisis. And usually this does not happen, because for instance, if you withdraw your money earlier than it was agreed with the bank, you will lose your potential profit, like what you have above your deposit. That's why normally you do not do this. But I don't know, if there is the lack of confidence or some financial vulnerability, then actually this might be the case. And actually this was the case in Ukraine and Belarus at least. I think in many other countries as well, I'm just judging on my own experience. When people wanted to withdraw their money from the banks because, there was some financial instability and no one trusted banks that much anymore. And banks faced liquidity crisis. So they were obliged to return the money kept on deposit, but they did not have enough liquidity in order to do this. So this is what liquidity risk is about. Default or credit risk. So this kind of risk is associated with non-returning credits. So, just some danger that some borrowers of the bank will simply not return the borrowing. And finally, we have interest rate risk. And when it comes to interest rate, you have to keep in mind that interest rate affects valuation of the assets. So usually you calculate market price of assets based on the present value of postponed flow of income. And in this case, changes in interest rate will affect prices of market assets. So according to modern portfolio optimization theory, which is a kind of a holy bible of financial investors, diversification can reduce portfolio risk to the level of systematic risk. Okay, so probably some explanations are needed. So systematic risk is the overall risk on the market. Like you cannot really reduce it. So if there is some financial crisis in Poland or political instability or whatsoever, all the investors who keep Polish assets in their portfolio will be affected. Like there is no way to handle this. You just, have to accept it and take this into account. On the other hand, when it comes to portfolio risk, in this case, you have to add the risk associated with particular assets. So for instance, if any Polish firm. Okay, for instance, if I have PKO BP bonds, then my risk includes overall Polish systematic risk level, as well as risk associated with this particular enterprise. Like, what will happen if the bank fails, if the bank becomes a bankrupt, and so on and so forth. So this is the idea. Portfolio contains several assets, and in this case, diversification means that you have different assets in your portfolio. So for instance, I know that firm A will be affected by the crisis negatively because, let's say, this firm sells some luxury goods. At the same time, the market value of the firm B will increase during the crisis. I don't know, maybe because they sell some cheap food or whatsoever. So in this case, if I buy both A and B assets, I have a guarantee that I will not fail. That regardless of whether there is a crisis or the period of economic expansion, I will get some return on my portfolio. So this is the idea. So by making sure that your portfolio is sufficiently diversified, you can reduce portfolio risk to the level very close to systematic risk. At the same time, this kind of judgment might be a bit problematic because when large financial institutions, which might, affect the entire economy, purchase junky assets for the sake of portfolio diversification, and junky assets are some very risky assets, let's say. So this is some slang or something, some special name for the very risky assets. So if large financial institutions do so, then it will not work. So they reduce their level of portfolio risk. At the same time, they increase the overall systematic risk level. And actually, this is what happened prior to the recent global financial crisis. So there is some, fundamental axiom in finance which states that return on assets should be positively correlated with risk. So in this case, you can calculate return on particular asset, like required return you would like to have in order to invest, as the sum of time value of money, or let's say just reward on, time value of money. So in this case, you assume that there is some market risk-free interest rate, and this interest rate is not associated with any level of market risk. So usually government bond yield is used as some proxy for market risk-free rate, because it's assumed that government bonds are the safest kind of investment in the economy. So market risk-free rate can be successfully assessed by analyzing government bond yield. Plus, you require some risk premium. And obviously, the higher the level of risk, the higher required risk premium is. So this is the idea. So just to sum up, a higher risk, higher reward on risk, higher interest rate. Okay, so it's not really visible. Give me a second. Okay, so as you remember, when there is significant negative permanent aggregate demand shock, then there is a threat of deflation trap. So previously we did not distinguish between policy rate and lending rate. And as you remember, lending rate cannot be lower than the negative rate of inflation in the previous period, because otherwise we will have negative nominal interest rates, which is kind of ridiculous. So the same applies to policy rate. Minimum level of the policy rate cannot be lower than rate of inflation in the previous period if we assume adaptive inflationary expectations. And in this case, we have negative aggregate demand shock, so IS shifts to the left, and at the same time, we have increase in the level of risk and increase in banking markup. So basically, as you remember, we discussed before, during the crisis, banks attempt to purge their balance sheets, and this implies that they charge higher lending rates. So this is what we observe. Now, instead of RS, we have RX, and actually this corresponds to this new point on the new IS curve. So for this interest rate, here is the corresponding level of output and corresponding level of inflation, and since it's negative, we are dealing with deflation. Okay, so obviously in the next period, because inflation level is smaller than inflation level in the previous period, Phillips curve will shift down. And taking into account this shape of Phillips curve, central bank would be located at this point when monetary rule intercepts new Phillips curve, and in order to do so, central bank will have to ensure this level of lending rate. But actually it's impossible, because in order to have this level of the lending rate, central bank will have to charge negative policy rate, because taking into account new banking markup. So actually in this case, central bank will do what is affordable, like charging zero policy rate, and this will not be enough. So probably we will be somewhere here, so we will end up with this level of inflation, and yeah, definitely this is not an optimum. So as you remember, in deflation trap, there is no way to leave deflation trap without any fiscal stimulus, or at least without any alternative kind of monetary policy. Because in this case, conventional monetary policy will be simply impotent. So, taking into account this restriction on the value of policy interest rate and the fact that banks charge some additional banking markup, it's just impossible. Okay. So unconventional monetary policy, also referred to as quantitative easing, can be described as purchasing assets by the central banks in order to boost prices of assets, like prevent the crash, and inject liquidity to the financial market. And before we proceed to some, formal analysis of unconventional monetary policy, first I would have to explain briefly what are bonds. So bonds are financial debt instruments. This is how corporations and governments can borrow money. So for instance, let's say the bond has face value of $1,000 and coupon rate is 10% and time to maturity is 5 years. So this means that for the first 4 years, you will get 1,000 times 10% every year, which gives you 100. And at the end of the 5th year, you will get your investment back, plus you will get this 100 of reward. So yield is a net return on bond. It's not identical to the interest rate. It depends on the price, and yield will depend on the interest rate as well, because price depends on the present value and present value depends on the interest rate, but they are not identical. And actually there is an inverse relationship between price of the bond and interest rate. So higher interest rate means lower price of the bond and vice versa. So now, keeping this in mind, we can analyze the effect of conventional and unconventional monetary policy. So here we have yield curve, and basically it tells you how interest rate, like payment on the bond, will depend on the maturity of bond. So short-term bonds are less risky because, there is smaller probability that some some bad stuff will happen in short run in comparison to the long run. So for instance, I can say for sure that there will be no default in Poland in the next year, but I cannot be sure about this when it comes to 10 years perspective. So that's why when time to maturity increases, level of risk increases, and subsequently required rate of return on investment increases as well. Okay, so here we have it. So here you have interest rate on small short-term bonds and interest rate on long-term bonds. So when it comes to conventional monetary policy, it will just decrease overall interest rate in the economy, and it will shift yield curve down without changing its slope. So obviously, short-term interest rate can be equal to 0. It's fine, because again, you cannot have negative nominal return on bond. It's ridiculous, just like negative nominal bank interest rate. But at the same time, for long-term bonds, we still have this level of interest rate. And there is nothing you can do about this. You cannot shift this curve even like further, because in this case, as I said before, it will correspond to the negative nominal interest rate on short-term bonds. That's why, this is it. So this is the limit of conventional monetary policy. In contrast, unconventional monetary policy will increase price of bonds, because as I said, the essence of unconventional monetary policy is central bank purchasing financial assets. So in this case, when central bank purchases financial assets, bonds, price of bonds increases, and if price of bonds increases, then interest rate decreases. Because as I said before, there is kind of inverse relationship. So in this case, the slope of a yield curve will decrease, and as a result, you still can achieve lower interest rate on long-term bonds. So this is how it works. So basically those two graphs demonstrate you that unconventional monetary policy will be effective even when conventional monetary policy will not be effective anymore. Okay, so now let's talk about automatic stabilizers. So as we discussed before, sometimes economy can find itself in deflationary trap or inflationary trap. And automatic stabilizers can be described as counter-cyclical mechanisms which work without explicit government intervention. And in this case, we have two kinds of automatic stabilizers. Those are progressive income taxes and unemployment benefits. So when it comes to progressive income taxes, the idea behind them is like this. When income increases, average tax rate increases, and vice versa. So for instance, in this case, you can see marginal tax rates associated with each level of income. So the person with income of 3,500 zlotys will pay 0 for first 2,000 and 10% for 1,500, which gives you $150, and average tax rate calculated as tax paid divided by income is just 4.2%. Analogously, if income is 6,500, average tax rate is 13%. So the idea is like this. When output decreases, income decreases as well. And when income decreases, taxes decrease. So you kind of you deal with contractionary fiscal policy, although, there is no contractionary fiscal policy. It works automatically. That's why we call this automatic stabilizer. And analogously, when income increases, like we have inflationary gap, output is above potential output, then taxes increase automatically, and, this gap is narrowed. Again, it works like contractionary fiscal policy with no intervention of the government. Analogously, unemployment benefits. So when we have negative output gap, like economic contraction, then unemployment increases. It's like, you remember, it's called cyclical unemployment. At the same time, when unemployment increases, more people receive unemployment benefits, which boosts consumption and increases aggregate demand. So as a result, this output gap is narrower, it's smaller. And vice versa, when there is the stage of economic expansion and inflationary gap, then there are less people unemployed, less unemployment benefits paid, and this reduces consumption to some extent. And yeah. Okay, so as I said before, automatic stabilizers work as the counter-cyclical fiscal policy. At the same time, like the difference between them and fiscal policy is that they do not require explicit government intervention. So, taking into account the effect of automatic stabilizers, we can define the concept of cyclically adjusted budget deficit. So, take a look at this formula. So, as you remember, budget balance is equal to government spending minus taxes. So, actually, yeah, this is budget deficit, because if it's positive, we have budget deficit. If it's negative, we have budget proficit or budget surplus. So, at the same time, here we have impact of automatic stabilizers. So, automatically, when unemployment increases, government has to pay more unemployment benefits. If income decreases, government collects less taxes, and so on and so forth. So it's assumed that if we have long run equilibrium, so YT is equal to YE, and there is no difference between them, then there is no budget deficit caused by the impact of automatic stabilizers. So if economy is in the long run equilibrium, or medium run equilibrium, and we still have budget deficit, we call it discretionary budget deficit. So this is budget deficit which exists even when economy is in equilibrium. Because if economy is in disequilibrium, the existence of budget deficit can be explained by the action of automatic stabilizers or effect of automatic stabilizers. But if everything is in equilibrium and we still have budget deficit, then again, we call it discretionary budget deficit. Okay, so in this case, let's proceed to the tasks. Not in this case, at this point, I'm sorry. So the first task, evaluate the following statement. Although diversification might purge idiosyncratic risk, it simultaneously reduces diversity and thereby increases systematic risk. You can put this video on hold and think about this for a while, but the idea is like this. Prior to the crisis, a lot of banks purchased junky assets in order to ensure a sufficient level of portfolio diversification. And this was fine, because we have some well-behaving assets with relatively low return, and we have some risky assets with high return, so portfolio is properly diversified. At the same time, the fact that such behavior increases the overall risk in the economy every investor faces was kind of ignored or neglected. So what I mean is that, yes, diversification allowed banks to reduce their portfolio risk. At the same time, it contributed to systematic risk, like overall financial risk in the economy. Okay, explain the role of the following factors in the upswing in the financial cycle that preceded the global financial crisis. Again, you can think about this for a while, putting the video on hold, but I will just, proceed to discussing this. So when it comes to point A, we also call this kind of behavior moral hazard. So the idea is like this. Banks would like to increase their profitability. At the same time, higher profitability is always associated with higher risk. So in this case, banks were aware of the fact that if something bad happens and they fail, then government will provide support. So in this case, when you know that you will be the person or the agent bearing the risk, then you are more careful. So maybe then you will prefer less profitability and less risk. But in this case, banks were aware that they will not bear the consequences of the risk, and yeah, that's why they were kind of careless when it comes to investment. Okay, the assumption that MBS bundled together in CDOs were not highly correlated. Again, so here you can recall this idea of diversification. If assets are not correlated, then actually it's kind of a safe option to include those assets to your portfolio. So it will decrease your expected profitability, but it will also decrease your level of risk. In this case, however, banks misinterpreted the market, and those assets turned out to be highly correlated. So that's why, this entire idea kind of failed. Okay, assume that an investment bank is at its maximum desired leverage of 20. Leverage is the ratio of debt to equity. So it has 10 million of its own equity and has borrowed 190 million to buy assets of 200 million worth. So then the price of these assets decreased. Now the market value is 195 million. And you have to figure out what happened to the bank's equity and leverage. And how much must the bank reduce its assets to restore leverage to its desired level, taking into account that other banks will attempt to do the same. So again, you can take your time to make calculations, and I will discuss the solution. So initially we had 10 million of equity, 190 million of borrowing, and 200 million of assets. So everything was balanced, and leverage was equal to 20. Okay, I'm sorry, I miscalculated this in Excel, took the wrong cell. So leverage was equal to 19. So this was borrowing to equity ratio, or debt to equity ratio. So yeah, and please take into account that balance sheet is balanced because we have assets equal to the sum of equity and borrowing. Then the value of assets decreased by 5 million. The value of borrowing is the same. So in order to keep everything balanced, equity must decrease by 5 million as well. So now we have leverage of 38. So basically 190 divided by 5. And if we would like to stick to the level of leverage equal to 20, it means that we shall have 100 million of borrowing. And this implies that, okay, and this implies that bank should sell 90 million worth of assets. Okay, so sounds nice, but the problem is that, government sells assets in order to repay borrowings, to decrease the level of debt and decrease leverage ratio. It may be kind of problematic, taking into account that other banks will do the same. So in this case, the value of assets might decrease even further in comparison to what we have here. And in this case, again, as I said before, it can be very problematic for the bank. Simply because, at this point, what was worth 90 million before at this stage is not worth 90 million at this point, because other banks sell their assets as well. So this increases supply and decreases market price accordingly. Okay, so that was it, and thank you for attention.